Ever watch a stock just bleed for weeks straight and there's literally no news? No bad earnings, no scandal, nothing. Just red candles day after day. Yeah, that's usually an ATM offering doing its thing. And most people have no idea it's even happening. I'm going to walk you through exactly what these are and why they quietly destroy stocks without anyone noticing. So what even is an ATM offering? ATM stands for at the market offering. Basically, it's when a company decides to sell brand new shares straight into the open market. But here's the thing, they don't do it all at once. They do it slowly. A little bit here, a little bit there. No big announcement, no scheduled sale date. They just sell whenever they feel like it. And the worst part, most retail traders have no clue it's happening. It's delusion in slow motion. Let me break down how this actually works. First, the company files what's called an S3 or S1 with the SEC. Think of it like getting permission to sell shares. Then they pick an investment bank to do the dirty work for them. That bank goes out into regular trading sessions, when you and I are buying and selling, and they just dump shares into the market. But they're smart about it. They sell into existing demand so the price doesn't crash all at once. They're careful. They're strategic. They drip feed those shares out. Picture this. Imagine someone standing over a cup with a water bottle, just slowly dripping water in nonstop. At first, it looks totally harmless, right? But if they never stop, eventually that cup overflows. That's what's happening to the stock price. Pretty sneaky, right? So why do companies even do this? Well, they need cash. Simple as that. Maybe they're burning through money. Maybe they're funding research. Maybe they're trying to grow fast. Whatever the reason, they need funds coming in regularly. And ATM offerings are way easier than doing one massive dilution event. Think about it. If they dumped millions of shares all at once, the stock would tank immediately. Everyone would freak out. But with an ATM, they can raise money quietly over weeks or even months without shocking the market. Plus, here's the kicker. They get to pick the best prices during the day. Stock pops on some hype? Cool. They'll sell into that spike. Stock running on momentum? They're dumping shares at the top. ATMs basically let companies cash in on hype without warning anyone. You see where this is going. Now, let's talk about why these things crush stock prices. It's pretty simple cause and effect. Every single day, more shares are hitting the market. That means constant selling pressure. Every time the stock tries to bounce, someone's there selling into it. Breakouts? They don't hold. The stock just slowly bleeds with no explanation. And here's the psychology part that makes it even worse. Traders start to sense that someone's selling above them, so they stop buying. Why would you buy if you know someone's going to dump on you every time it goes up? Then panic sellers start exiting earlier because they don't want to get stuck. The whole thing feeds on itself. It's a slow bleed. So how do you actually spot one of these in action? I'm going to give you the signs. First, stock bleeds day after day with zero catalyst. No news, no reason, just down. Second, every pop gets rejected. Stock jumps 2%, immediately gets sold back down. Third, volume spikes during green candles, but the price barely moves. That's shares getting absorbed. Fourth, the company recently filed a shelf offering. You can find this in their SEC filings. Fifth, check recent 8Ks. Sometimes they literally mention ATM program right there. And sixth, look at their cash balance on the last 10Q. If it's low and they're burning cash fast, that's a huge red flag. These clues will save you so much pain, trust me. Now, where do you see ATMs the most? Let me give you the usual suspects. Small caps, biotechs, growth companies with negative cash flow, penny stocks, SPAC merger companies, basically any company with a high burn rate and no profits yet. These are growth companies. They're startups. They're trying to build something and they need cash to survive. So they use ATMs to keep the lights on. It's not always evil, it's just survival, but it wrecks the stock price. But here's the thing though, not all ATMs are created equal. Some are way worse than others. If you've got a low float stock with an active ATM, that's brutal. The dilution hits harder because there aren't many shares to begin with. High offering size makes it worse. If the company's burning cash super fast, that's another red flag. And if they activate the ATM right after good news, that's the ultimate trap. Good news pumps the stock, and they're selling into the excitement. Combo of all that creates non-stop selling. But let's be fair for a second. An ATM isn't always bad. Big companies use them safely. Solid firms raise small amounts without causing chaos. When the fundamentals are actually strong and the company's making money, the ATM has way less impact. The stock might dip a little, but it recovers. It's the small caps with no revenue that get destroyed. So how do you protect yourself as a trader? Here's what I do. Always check for ATM language in the filings. It takes 2 minutes. Compare their cash runway to their burn rate. How long can they survive without raising more money? Track recent S3 or S1 filings. Those are your early warning signs. Avoid chasing low float stocks with active ATMs unless you're just scalping. And always watch the price action. If it's bleeding with no news, that's your cue. Look, here's the final takeaway. ATMs don't kill stocks instantly. They bleed them slowly. If a stock keeps dropping and there's no news, no earnings miss, nothing, check the filings. Someone might be selling above you every single day. And once you know that, you can either avoid the stock completely or wait for the offering to finish before jumping in. This is one of those things they don't teach you, but it happens all the time. Once you start spotting it, you'll see it everywhere. Hope this helps you on your quest for profits. Catch you on the next one.